Good morning, everybody, and welcome to today's webinar, 32 Ways to Save Tax and Extract Value from Your Business. And this is in conjunction with the Chichester Chamber of Commerce and Industry. My name is Andre, and I am the practice manager here at Rouders Chartered Accountants, and I'll be your moderator for today. For those of you who are unfamiliar with the Zoom platform, there is a Q&A button at the bottom there. If you can please submit any questions in that so that we can go and answer those questions at the end of the webinar. There's also an audio settings button where you can test your speakers and select basically how you utilize basically or hear the content. And then there is also a leave meeting button if you need to leave for any reason. Now, to go over to the presentation, I would like to go and introduce our presenter for today, Penny Rowden, one of our directors. And hi, Penny.
Hi, Andre. Thank you very much. And welcome everyone who's joining us today. It's quite a thing, tax, isn't it? And it's going to be, hopefully this will be a very informative webinar to help you find some ways that you can extract value from your business. First of all, I wanted to start off with some advice from Lyra, our head of marketing and author of our blogs from the dog. There we go. Don't let the tax tail wag the dog. So however good a tax saving might seem to be, do look at the big picture. Is this what you want to do? Are you saving some tax, but actually buying something you don't need or might have other consequences? Also, don't get seduced by some of the elaborate tax saving schemes that are out there. We've all seen the trouble that some of the celebrities have got into with some of these schemes. The general rule is if it seems to be good to be true, then it probably is. Also, tax is a very complex area, so do take advice, as what might seem simple at face value might have an impact elsewhere. With that proviso, let's crack on with looking at some legitimate ways that we can extract value from our businesses and save some tax. All business owners want to know this. 32 ways to get the maximum value out of your business and do it tax efficiently. Every business owner can extract loads of value from their business. If any of these ways relate to your life, your business, or your plans, do make sure they're being done as tax efficiently as possible. As the old saying goes, it ain't what you do, it's the way that you do it. This slide summarizes the key areas of the 32 ways you can extract value from your business and save tax along the way. We'll be investigating more of these in detail during this webinar. So the agenda for today is firstly to provide an introduction as to what we're planning to show you during this webinar, and then move on to the key topic areas, which are salary and dividends, pensions, loans, business assets, employee benefits, other tax efficient benefits, business expenses paid for personally, and then we're going to come on to next steps. And then questions and answers, and I'm hoping that Jonathan will be with us to sort of share any of his advice for any questions you've got, and also to correct me if I've said anything wrong during this webinar, because as I said, tax is a very complex area. And then we're going to close, okay? So we're going to come on to next steps and what you can do after attending this webinar to make your business more tax efficient for you, allowing you to get more benefit from the business. So first of all, introduction. Tax advice to business owners is usually limited to advice on optimum salary and dividends, examples of costs that are tax deductible, how to reduce business taxable profits in general terms to reduce tax, e.g. buy assets just before the year end. What we want to do with this webinar is to show you the many other ways you can extract the value for yourselves as business owners, your family and your employees in a more efficient way and reduce your personal and business tax. Not all of the 32 ways we will introduce you to today will be relevant for you and your business, but we're certain that some will be, so you will get value from attending this webinar. Please take plenty of notes and do ask questions. If we don't have time to answer them all, I will circulate these in our email newsletters and in our Facebook group. There will also be a checklist available, which I will send to everyone who wants it, who is attending the webinar today, which goes through these key areas and will act as a trigger for you to think, well, maybe that is an area that I would like to look at in more detail or get further advice on. So now we're going to go on to salary and dividends. So I think it's fairly well established that generally the most efficient way for you to pay yourself as a company director is a combination of low salary and then also dividends. But what should that salary level be? Now, if you're the only employee in your business, then the optimum salary for you is normally £737 per month. However, if there are multiple employees in your business, then that becomes slightly higher at £797 per month, providing there is sufficient national insurance employer's allowance available.
Right.
In both these cases, access to state benefits will be maintained, even if no national insurance is payable. But there are times when this salary level should be different. For example, if you can't take dividends or have other investors, which might affect the level of dividend that could be taken, you might want to have a higher level of salary. If you're heavily involved in research and development, your salary can qualify for enhanced relief against corporation tax, making it more efficient to pay a higher salary rather than dividends. If employment allowance is available, this can mean that a higher salary can be paid without incurring employers' national insurance contributions. This could, for example, make it worthwhile to have a salary of £12,570 per annum. Here, the only cost would be the employee national insurance. An employee over state pension age will not pay national insurance contributions. So, for instance, a 68-year-old could have a £12,570 salary with no tax or employers or employees NIC if the employment allowance is available. Also, if you're looking for a personal loan, such as a mortgage, then some lenders will base their credit scoring on employment income rather than dividends. There are lenders out there, though, who will take the whole income into account. So we come on to employing spouse, etc. If they have a lower income than you, think about employing a spouse, civil partner, or family member. It is important that their pay can be justified in terms of what they do for the company. This way, the company can benefit from the additional resource. The individual can utilise their personal allowances and or lower level tax bands, and the company can potentially make an NI saving. For a single employee company, employing an additional employee may also make the employment allowance available. So let's look at dividends. Now, after salary, this is the most common way that business owners will pay themselves. It is very important to note that dividends are paid out of after-tax profit and aren't a tax-deductible cost. It is your way of rewarding yourself for running the business that you own, so dividends are paid to shareholders. We do need to make the distinction that directors and shareholders aren't always the same person, although often for owner-managed companies they will be. The first thing to note is that the first £2,000 of dividends are tax-free, so if possible, do try and take that amount annually. After that, up to £50,270 at current tax rates of total income, the tax rate on dividends is relatively low at 7.5%, a very efficient way to pay yourself. Above £50,270 of total income, you pay 32.5% on dividends and could also lose entitlement to certain benefits and allowances, e.g. child benefit. So above that threshold, once you become a higher rate taxpayer, you could look at giving shares to a family member. Now, transferring shares to a spouse is not subject to potential capital gains tax, but if you give them to other family members, it could trigger a capital gains tax liability. So it is really important that you get advice on this, on what is the right thing to do. So next we move on to pensions. Getting the company to make contributions to your personal pension scheme is a very tax efficient way of contributing to your financial planning for your future. It's important to consider the lifestyle that you want when you stop running your business. What value of assets do you need to accumulate, and what level of income do you want? These are important questions that need to be considered as part of an overall strategy. Carrying out a full individual and corporate tax diagnostic is essential to ensure these issues are considered as a collective, e.g. building the value of your business, building your personal wealth, and structuring all your affairs with long-term goals in mind. However, here we're only focusing on pensions through the lens of tax efficiency and maximising value that you can extract from your business. Pensions can be a very efficient way to put money aside, as you pay no income tax or national insurance when the money is paid in, subject to certain limits. You also get a corporation tax deduction on the money paid in. Any income or capital gains generated from the funds within the pension are not taxed, and the fund can be accessed tax efficiently from age 55. On withdrawal, a lump sum of up to 25% of the fund can be accessed tax-free. Withdrawal of the remainder is taxed, but can be spread across multiple tax years, making the most of personal allowances and tax rates. Please note that the contributions need to be made into registered personal pension schemes, and there is a distinction between a personal pension scheme, where the company can make the tax-free contributions for you, and a workplace pension scheme, where you personally have to contribute as well. Having the business pay into a personal pension scheme is the route that we would normally recommend to business owners. Unless you earn over £240,000 per annum, the maximum annual amount that can be contributed with no income tax or NI, but a full corporation tax deduction, is £40,000 and is not linked to your salary. This allowance is restricted for those earning over £240,000, with no annual allowance at all if you earn over £312,000. And you can also carry forward any unused allowance for up to 3 years. And that was really just to say about the registered pension schemes. So our next slide is now loans. Now, when I talk about loans, I'm talking about money you are lending to the business, providing your employees with loans, and also borrowing money from the business. Now, looking at the first point, when business owners start up their business, they often have put personal funds into the business. It is very rare that they would even consider charging the business interest. But every individual who is a basic rate taxpayer can receive up to £1,000 of interest tax-free if they haven't used up their savings income allowance. For higher rate taxpayers, it is reduced to £500. There will be some admin involved in reporting the loan to HMRC, but do also remember that that interest is tax deductible as a cost for the business. So it is a way that you can take money out of the business for yourself and reduce your business tax liability, and actually your personal tax liability too, because otherwise you might have taken that money out as salary or dividends. Business owners also don't often realise that they can always take out any money lent to the company tax-free at a future point, once the company has sufficient funds for them to do so. So now looking at employee loans, you can provide interest-free loans of up to £10,000 to employees and you, and that can be a great way to reward your team members and encourage retention, as they will have to repay the loan when they leave. And then we look at borrowing money from the business. It may be that your business has surplus cash, and perhaps you need some of that cash for a major purchase, such as buying a home or building an extension or something. You don't necessarily want to take that as a dividend, and there can be times when it is more beneficial for you to take that as a loan through the business. However, if you are in that situation, then we would very much advise you to speak to us or your own accountant to get advice on the best approach to take and the tax consequences of doing this. We can then look at business assets. If you allow your company to use personal assets, such as property, then consider charging rent for their use. This is another effective way to extract funds from a business tax-free. It enables you to receive the rent in lieu of additional salary or dividends. The rent isn't subject to national insurance, which of course salary is, and it is also deductible for corporation tax, unlike a dividend. It can also be very tax efficient to have the property owned by a pension scheme which rents it to the business. There are some potential reliefs to watch out for, such as restriction of business property relief. So again, we would advise that you take advice to avoid any pitfalls that you might not be aware of. Equally, certain business-owned assets can be used by a business owner without any tax implications, providing private use is minimal. A good example is a laptop, which you need for the business, but use at home as well. Definitely worth considering buying through the business. This is in contrast to buying something like a gaming console, where the primary use would not be for you personally, so not allowable. So we now move on to employee benefits. Normally, if a benefit is provided to you, it will be taxed in the same way as a salary. However, there are some exceptions to this rule, detailed in this slide, which can result in significant cost savings in the form of corporation tax, VAT, income tax, and NIC. For example, if a cost can be incurred by the business, the equivalent saving, ignoring the VAT savings, which could be a further 1/6 on the monthly cost, could be around 25% if you take dividends and are a basic rate taxpayer, 45% if you take dividends and are a higher rate taxpayer, 40% if you are salaried and a basic rate taxpayer, and 49% if you're salaried and are a higher rate taxpayer. So you can see that these benefits can be well worth looking at. So first of all, we'll come on to life insurance. Relevant life insurance policies usually pay out a sum to beneficiaries in the event the insured person, e.g. the business owner, dies. Alongside the monthly tax cost savings, policies can also be written into trust so that they're outside the scope of inheritance tax. Obtaining cover for the wider workforce can also be a great way to retain employees. Then pensions advice. This is an interesting one. If you need to seek pensions advice, it's tax-free up to £500 in value if it's paid for by the business. So that's worth having a think about. And then mobile phones. One mobile phone can be given to every employee in the business, including you and any family members that are employed. And there is no tax or NIC, regardless of whether the phone is used for personal calls or messaging, etc. The contract must be in the company's name. It is also possible for the company to offer a second mobile phone to you and certain employees purely for business purposes. This would allow employees who want separation of home and work matters to have two mobile phones. Now, vouchers. This is anything except cash that does not exceed £50. These are also known as trivial benefits and are subject to certain restrictions. However, in short, you can buy anything via the business as a way to extract value, e.g. perfume, an Amazon gift card or something like that, providing it costs up to £50. For you as a director, these trivial benefits are capped at £300 per year, but there is no limit for employees. The gift can't be able to be traded in for cash, must not be part of the employee's contract or salary, and must not be performance related. Giving benefits like this to staff can be massively rewarding for them, helping to achieve motivated staff and high retention levels. For instance, we'll always try and give an Amazon voucher as a birthday gift to our team members. So staff functions, this is always a popular one. Providing the cost per attendee is less than £150, an event for staff, e.g. at Christmas, is not taxable on you or your employees. Employees can bring a guest, and the £150 allowance is per person, not per the member of staff. The exemption can be aggregated over a year, so you could have several events which would still be tax-free, providing the total cost in the year was £150 per head. Employee car parking. So if you have to pay for a car parking space, then the company can pay this for both you and your employees tax-free, so long as the car park space is at or near your office. VAT registered businesses can also reclaim the VAT on the cost. Another benefit is training. Work training can cover a wide range of areas that are wholly for business purposes, such as professional development and health and safety. The business can pay for this and recover any VAT as well. So we now come on to other tax efficient benefits. First of all, lunches and snacks. Provided all the staff are offered the option, providing lunches to staff at the business premises is tax-free to all employees, and the business can claim corporation tax relief and recover VAT where relevant on the costs. The costs must be reasonable, so no sort of piles of champagne and all that sort of thing. Next one is childcare support. There are three potential ways to help fund childcare in a tax efficient way. The current one really is the tax-free childcare, which is a scheme that allows you to save up to 20% on childcare costs. The government will contribute up to £2,000 per year for each child in childcare. The previous scheme, childcare vouchers, are now only available if you signed up to a scheme, which is still operated by the company before 4th of October 2018. This scheme was more tax efficient than the new tax-free scheme, so should definitely be considered if you're still eligible. And then the final one is workplace crashes, which aren't practical for most businesses, but if it is an option, is worth considering, as it can be provided with no tax or national insurance liability. Bikes and equipment cycle to work scheme. So bikes and equipment can be purchased under a salary sacrifice scheme so that the cost of the equipment comes out of pay before being taxed. This has tax and NI savings for the individual, up to 47% for higher rate taxpayers, and also gives an NI saving to the company. This saving can also be passed on to you to make it even cheaper to get the bike. There is now no limit on the cost. It used to be £1,000. So a top quality bike plus accessories can be bought with significant savings available. The way the schemes work in practice is that there is an initial rental period, usually 12 to 24 months, after which you can hand the bike back, buy it at its current value, or continue to rent it from the cycle scheme provider at low cost. Choosing the last option is usually the most cost effective, meaning you can own the bike outright after 4 or so years. On-site gyms and sporting facilities. These are free of tax if they're available to all employees and not open to members of the general public. And the facilities are used wholly or mainly by employees, former employees, or family members of these groups. Multiple businesses can use one set of facilities, allowing shared gyms in communal office spaces. It'd be great if we had room for one of those, but I don't think we do really. Taxable benefits, which are still worth considering. So it's also worth considering these other benefits that can be offered to you and your employees. Whilst they're not tax-free or available as a salary sacrifice scheme, they can have other benefits, such as you may get better rates or premiums for bulk buying for a number of individuals, e.g. medical cover or shareholder protection insurance, and that which allows remaining shareholders to buy out the family of a deceased shareholder, or critical illness cover or income protection insurance. Even though these are taxable, it can be hugely incentivizing for employees to have this kind of cover. So company cars. In recent years, the tax on company cars has increased to the level where it is not usually financially viable for the company or the user of the car. However, there is one main exception: electric cars. Just to give you some background, where company cars are provided for specific individuals, a taxable benefit will arise on the individual and is reported to HMRC on the dreaded form P11D. This is based on a percentage of the list price of the vehicle, not the price you paid for it. So buying that second-hand Jag from Del Boy for £1,000 won't make a bit of difference if the list price was 100,000. And the calculation is also coupled with its CO2 emissions as well. So again, high emitting cars can be very, very expensive if bought through the company. So the use of lower emission vehicles can generate significant tax savings. Fuel costs provided by the company will also be subject to an additional benefit in kind charge. unless it's purely for business purposes or the private element is reimbursed by the employee. Now, an electric car, that can mean a pure electric car or a hybrid. There are two key tax advantages available if the car meets the relevant conditions. Low tax on the individual user, and if the business buys the car, 100% corporation tax relief is available in the year of purchase, but you will need to keep it for a minimum of 4 years to avoid any clawback of the relief. Another tax efficient benefit is charging electric vehicles. So the cost of charging vehicles at your place of employment is exempt from tax and NICs. It makes no difference who owns the car. It is also possible for you to receive a tax-free benefit if a charging point is installed at your home, provided you have a company car. However, it would be taxable for a personal car used for business purposes. Then running costs for company-owned vehicles. So with the exception of fuel, the benefit in kind charge covers all motor running costs, including costs such as servicing and insurance. Where a vehicle is provided, but insurance is not, the company should consider providing insurance too. It will be deductible for CT, i.e. corporation tax, but no additional tax charge will arise on the individual. So that's well worth thinking about. Sorry, I've just gone back one. I just want to go back one. Then just also there was childcare support as well that I've put in here as well. That's interesting. Sorry, we've gone right back to the beginning there. Let's just get back on to charging electric vehicles. So, and then there was just one other thing, that was car accessories are included in the value of the vehicle when calculating the company car tax charge. But there are two accessories you could purchase via the business, which are tax-free. Personalised number plates or hands-free kit and equipment, e.g. charging cables or cradle for your mobile phones. So if you fancy a personalised number plate, then the company can buy that for a company car. So let's get on to business expenses paid personally. Home working expenses. So in these days of the pandemic, you and your employees may work regularly from home. I know certainly our team are. So this increases the cost of some home bills like heating, light, faster internet, etc. And so HMRC allow an amount to be reimbursed to you to reflect the additional cost of working from home. As a result of the pandemic, the government has increased the working from home allowance to £6 per week or £26 a month. This allowance doesn't need any record keeping and the amount is paid tax-free. However, if the cost is greater than this, then records need to be kept to prove the additional cost. Where this is done, again, there should be no income tax or NICs on the additional payments. Due to increase in working from home for so many, we have created a spreadsheet template to calculate use of home costs, which you can be paid tax-free, and also a home rental agreement template, which should satisfy HMRC as well. So if you're interested in receiving either of these, then please do get in touch. So the next one is mileage claims. Make sure you're claiming for all business miles. Where you use your own car for business, excluding commuting to and from work, you can claim 45p for each business mile travelled up to 10,000 miles per annum and 25p per mile thereafter without any income tax consequences. If you carpool with a fellow employee or director, then you can get an additional 5p per mile as well. And then there are rates for motorcycles, and actually for bicycles, 20p per mile can be paid tax-free, which seems like a pretty good wheeze to me if you can cycle to work. The company can also claim a tax deduction for mileage payments paid to employees as well. And if you want to go there, a small amount of VAT can also be claimed on the business miles for VAT registered businesses, providing that you do keep the VAT fuel receipts. It's pretty small, so it might not be worth the hassle, but some people do. We can tell you how to calculate that if you're interested. So next, congestion charge. So If you incur the congestion charge whilst travelling to London using your company car, you can put the cost of the charge through the business. Sorry, I'm just going to take some water. So the next one is business travel. You aren't allowed to claim the cost of commuting to the office, i.e. your business address, even if you only go there infrequently. However, there are some exceptions. It just might be worth thinking about. So late night working costs. So if you've been working late, usually until at least 9 p.m, you can get a taxi home and the company pay for it. It would be tax allowable. There are rules. It must be irregular. You're working late for business reasons and where public transport has stopped, or it would be unreasonable to use it. It can be used for up to 60 journeys per year and has no maximum amount per journey. Another one of these is failed car share arrangements. So if your lift home with another director or employee isn't possible because they've had to go home for some reason, then again, you could claim taxi fare or public transport fare. Public travel costs. You can claim for public transport if you're traveling for business, e.g. client meetings or conferences. And then the other thing to think about is first class or business travel versus standard class travel. Generally, the cost will not affect the claim for tax relief, especially if it was necessary for the journey. So this would include long journeys to enable sleep, etc., prior to a business meeting, or you require privacy and space to work whilst traveling. That's why people will obviously often travel business class on aeroplanes or first class on a train or something like that, and that's perfectly allowable. Or equally, if you're traveling alongside a client who's chosen to go first class or business class, then that will be allowable too, without any benefit on you. So next we come to subsistence and entertaining. So if you're carrying out your directed duties, such as attending a client meeting or traveling for business, you can claim your drinks and meals back via expenses, tax-free, providing receipts are retained. So that really falls under the heading of subsistence. You can also claim incidental overnight expenditure. So if you're traveling on business and are required to stay overnight, you can claim £5 in the UK per night or £10 overseas for incidental travel costs, like newspapers, laundry, etc., without any receipts. The limits are VAT inclusive, so just bear that one in mind. If you exceed this limit per night, the whole amount becomes taxable as employment income rather than just the excess over the £5 or £10. And then entertaining. You can claim the cost of entertaining clients and put it through the business. Whilst the entertaining itself isn't tax deductible and you can't claim the VAT on it, it's still far more effective to put it through the business rather than pay it out of your own pocket, where you're paying for it out of after-tax income. So again, bear that one in mind. We normally have a separate code for it called entertaining. So pop it in there in your accounts, and then we add it back when we prepare the accounts and the tax computation, but still well worth doing because you're only really getting charged at the tax rate for it. So this is an interesting one. Music, audiobooks and Amazon Prime subscriptions. So if you have, say, an Audible subscription to listen to business books, put it through the business. It's a good wheeze. Similarly, if you have a business Amazon account and want to have Amazon Prime for free delivery, put it through the business. The same with the Spotify account to listen to music in the office or create specific business-oriented playlists. Yep, I gather that is a thing to motivate your staff or to encourage core values or whatever it is. It will be allowable for corporation tax and tax-free for you and your employees. Just remember that you will be required to register for a music license if you are playing music in your office or even playing the radio, even if it is on headphones. So points rewards cards. If you or an employee has a personal card that you use for business expenses, any points received from the reward are not taxable on you. A good example for this is Air Miles. Similarly, a company card that receives points can be used by the business owner to pay for flights without any tax or NIC on the individual. And then the final one is schools and university fees planning. The cost of school or university fees for your family can be extremely expensive for us, especially as these fees are paid out of after-tax income. There are various ways that you can pay for this efficiently through the business or through the use of trusts and family members. So if that is something that is relevant to you, do look into it. And if you want further information or advice on this, then please do get in touch. So what are the next steps? You've attended the webinar, and it's then important to identify those areas that you think are relevant to your business, your family and your team. Then you should quantify the potential benefit that there could be for you, and then really plan how you can incorporate some of these 32 ways into your business. Now, how can we help? Well, what we've just started to provide for clients is what we call a tax diagnostic review. And the reason for that is that, particularly sort of during the pandemic, we've been thinking a lot about how we can really formally help clients to get the best out of their tax benefits. And it's actually quite difficult to do that when you're just sort of looking at accounts and everything else. You really do need to have a proper discussion with the clients and actually formally go through the whole of the sort of tax planning checklist and what their plans are, their goals, what they're looking at for their retirement, etc., etc. So we've now been doing this tax diagnostic review, and so specifically we've designed this to help you get more value from your business, and we'll identify all the tax advice needs, tax saving opportunities, allowances, incentives, reliefs, and all that sort of thing applicable to your business. And how this works is we will complete a full analysis of the 32 ways to identify all the tax advice needs, tax saving opportunities, allowances, incentives, and reliefs that's applicable to your business. We'll then produce a detailed report outlining all of this, tax advice needs, the tax saving opportunities, allowances, etc. And then we'll produce an action plan, which will outline the priority areas for you and your business to focus on, including estimated tax savings and quotes for the delivery of recommended advice, tax advice. So this tax diagnostic, how does it work? So to start with, we'll complete the diagnostic review analysis, work through it with you, and schedule a date to discuss our initial findings with you. And then on a 30-minute call, we'll briefly discuss the findings of the report, clarifying any required details so we can produce the final report and recommendations for action. So we'll then produce the final report and recommendations of the action that you need to take, including the estimated tax savings, and also provide you with costs for doing any of that additional work. Because then again, there is a distinction here. The tax diagnostic is for identifying any opportunities for tax savings for you, but actually going through and implementing some of those may involve an additional cost depending on the work involved. And then we'll wrap up with an action meeting where we can provide the detailed report, action summary, and present our recommendations to take forward the tax advice identified for you and the business. So we're currently offering the tax diagnostic review for £495 plus VAT. In addition, we'll also provide a free 32 ways checklist. Just email me on penny.rowden@rowdens-limited.co.uk and I'll send you a copy. Or alternatively, you can go on the website and request a copy as well. So if you want to go through this yourself, have a look at the checklist and tick off the items that are relevant to you and your business. Now, if you're considering a tax diagnostic review, then in addition, we're offering guarantee that if we can't find tax saving opportunities for you of at least £1,500, then we'll not charge you for the tax diagnostic. We are pretty confident that by doing a detailed review, you will identify tax saving opportunities. So we stand by that guarantee. Some of the tax savings we've achieved for clients in the past have been in excess of £10,000. So if you look through the checklist, potentially that has huge amounts of value for you. Remember that the tax diagnostic review is a one-off, but the potential tax savings that you're going to make, you're going to benefit from that for years to come. So that's just the guarantee there. And now we come to questions and answers. So I don't know, Andre, if we've had any questions and answers.
Yeah, no, thank you very much for that, Penny. That's very kind of you, Richard, to run through that. And I think there's, like you said now at the end there's definitely loads of tax savings to be made. We've had quite a few questions sort of come in. One of the questions that we had there is, I think this is related to the mileage. If you have, to mileage basically there. How important is it to keep a detailed mileage log? Would you be penalized, or would the expenses possibly be disallowed later if investigated? If you couldn't provide a mileage log, and then how likely is this to be investigated?
I mean, who knows? The revenue don't always investigate just people who they think are looking a bit dodgy. They can do an investigation on anyone, and they will do sample investigations at any time. And actually, as a result of various suspicions of fraudulent claims and things, as a result of all the tax relief, all the reliefs and grants and everything that, like furlough, etc., that's been available through the pandemic, they're actually have set up a fraud squad to specifically test, specifically target companies and things. So I think it's always worth doing everything absolutely, legitimately, and keep records of everything that you want to claim, because there is no doubt that if you can't prove it, then you could well have to pay it back. And we have had clients in the past who've tried to put through travel and expenses and had them disallowed. So and then usually there's tax and penalties, so it isn't just losing the tax that you saved by claiming it. So I would always keep a detailed log. There are apps available. We recommend an app called TripCatcher that links with Xero and actually Dext as well, and is very easy to be able to record your mileage on it, and it will actually also calculate the VAT, that little bit of VAT saving that I mentioned. So that's a really good little app. It only costs about 15 quid a year. It's excellent. Just have it on your phone, and then you can either just put in the postcode of where you're going to and from, or just click it on when you start your journey. So it can work on either. And it will record everything for you, and it will even do the extra 5p a mile as well for shared journeys, etc. So it's a great little app, and as I say, it integrates beautifully with Xero. So that's one way of doing it. There are other apps available, but that's the one we tend to use.
Penny, can I also just comment? We did a blog on this back in July about Inland Revenue have a sense of humour, because a taxpayer did try and claim that he'd done 60,000 business miles. And the revenue got computers that went onto the internet and actually found out from his MOT records that he'd only done a total of about 38,000 miles. So they weren't impressed. They disallowed all of it, gave him penalty and interest charges, and just wasn't worth it. So they do find out through various means. They're not totally stupid. They've heard of computers. So keep a record, please.
Thank you very much, Jonathan and Penny. Just very quickly, we've got another question coming in here about the tax diagnostic review fee. Is that per individual or per business if there's multiple shareholders or multiple directors?
It would be per individual.
Okay, that's fantastic. Thank you very much. I've got another one here, which is if you're on a business trip and there is some non-business activities, what constitutes as claimable costs?
Sorry, say that again.
So if you're on a business trip, so going out to see clients and everywhere else, but there is an element of it that is non-business activities, what would be claimable?
Yeah, it's one of those things that generally sort of any private activities won't be claimable, but if it's something that's incidental to the business trip, so for instance, you've been up to London to see a client, and then you decide to go off and have a coffee or something afterwards, then that wouldn't stop you claiming the trip back, you know. But if you, I think a lot of it depends on whether there's a detour as well. So if you couldn't then sort of claim the personal activity that involved a detour, that might become, you know, if it's more than the business trip itself, then that's an issue. So generally, you know, it really, it's sort of on the facts of the case actually at the time. But if it's a sort of something that's personal, just as that's very incidental to the bit of business, then, and there's no detour involved, then that would be fine. But it wouldn't stop you disallowing the whole trip.
Yes, Penny, I think that the key phrase the revenue love to talk about is duality of purpose. There's a phrase, if you Google that, you'll see all the answers. So kind of the revenue looking to see what's behind the reason for your trip and the length of the trip. So if you just decide to go and see a very small client in Orlando for 3 weeks and spend all the rest of your time going to the theme parks and having well over time, the revenue may give you a hard time of claiming that was a business trip. But if you're going to a trade show in Chicago, for example, that lasts a week and you spend a few days afterwards seeing the sites, then you can disallow a proportion of the business, of the total expense, to say, well, that relates to personal use because it really was a business trip to a convention in Chicago. So if you want to know more, look at Google duality of purpose and have fun reading. I guess the revenue been there and got the t-shirt, I suppose, is the phrase to use.
Just very quickly for Mr. Rowden, I think this might be something for you to answer there for us. The question that we have here is, can I rent the front room and or the garage basically of a house owned by my wife where I am not on the deeds? My wife is employed and is a lower rate taxpayer. Is that something possible for somebody to do if they're working from home?
I think again, you'd have to look at perhaps this template to see what would be a fair charge for it, because obviously it potentially would be taxable income, and there are other things you might also want to think about, which might be, would your mortgage provider be totally happy? I appreciate they may not know what's going on. Check your insurance as well, because it may be something that increased home working from home. I think the insurance company said that increases the risk, so perhaps you should let the insurance company know. But I think if it's a reasonable charge and you can justify the expense, it's no different to you working from your own home and charging the company the rent.
You do have to be very careful that you don't try and charge like 100% of anything, because that can affect your principal private residence relief as well, can't you, Jonathan?
Exactly right. So you'll probably, if you look at the template, you probably see it talks about how it's a non-exclusive use. You can use it for other things. So, I mean, years ago, vets used to have their Christmas lunch in the surgery and take a picture of it just to prove to the revenue that they did use their veterinary surgery, which is usually their home, was not exclusive use of business. But in those days, I guess you can have a YouTube video of you having that, enjoying the spare office room.
Thank you very much. That is it, I think, for the questions at the moment.
Actually, there. I've just noticed there's one in the chat as well. Andre, can a director only payroll benefit from the cycle to work scheme? And if the bike is purchased at the end of the period, what are the tax implications of the employee being the owner of the bike? Yes, I think I'm right in saying, Jonathan, aren't I, that a director only payroll can benefit from the cycle to work scheme?
I'd have to check that, because normally
Yeah.
the bike scheme has to be made available to all employees usually. Obviously, the director can frown at the employee who asks for a bike to work scheme, but I think on the face of it, I would go yes, but we'll check and come back to the person who asked the question.
Yeah, and then, you know, if the bike is purchased at the end of the period, what are the tax implications of for the employee being the owner of the bike? That there aren't any. That's, I think, that's the whole point, really. That as long as you, you know, sort of buy it at the end of the period, then that's, you know, I think I'm right in saying.
Yes,
that was
I think
what I read.
buying at the end of the period is always the benefit for the employee, because a used second-hand bike, you know, 3 years old, that's been up and down the South Downs, is not a great deal of money.
Yeah. Yeah, I think so. Is that?
That is it, Bessie, that I have from my side at the moment. But thank you very much to you both. I think Bessie was very informative and very useful. And then, like I said, I just want to go and add, if there's any other questions, please feel free to send us an email, give us a phone call, and we can always go and discuss these things in more detail. Thank you very much.
Okay, yeah, and so really it's just to say thank you very much to, you know, for everyone to attending from my side as well, and really hope you've got some value out of it. I'll just pop the, let me just get rid of the and just pop the final thank you slide. But it's great to have you all on the webinar today, and look out for further webinars from us. I think we'll probably miss them in December. I don't think we've got probably enough to do, but they'll probably start again in February. So do look out for anything, and also for our blogs from the dog and the newsletters, the monthly newsletters that we're sending out. And these webinars are on our website as well. So if you want to have a look again, or you know, encourage anybody else to watch it, then do get them to have a look at the website, and get in touch if they need any help. That's great. Thanks very much, everyone.